Today we are talking about a topic that will intrigue many. Handbags.
Ah, yes, a perennial favorite.
Indeed. And specifically, our deep dive today comes from a really insightful article in The Economist. It's called Bags of Money.
A great title. It really sets the stage for looking at the business side of luxury.
Exactly. So we're going to unpack how Hermès has managed to, well, weather the current slowdown in the luxury market.
Which is definitely happening.
Yeah, and we'll look at how its competitors are faring and really try to get to the bottom of what lies behind Hermès's, remarkable success.
It's a really interesting time in the luxury sector, isn't it? There's a clear divergence. Some are struggling, while Hermès seems particularly resilient.
The article really paints that picture. It mentions the headwinds, the cooling Chinese economy, cost of living pressures in the West.
Uh-huh. And even the sort of shadow of potential tariffs, like those threatened by Donald Trump, these things are definitely putting a strain on luxury sales overall.
They really are. I mean, the piece points out, Kering, they own Gucci, right?
Yeah.
They've actually issued profit warnings.
That's significant.
And even LVMH, the absolute giant with Louis Vuitton, they're seeing sales slow down in their fashion and leather goods division.
So it underscores the pressure. It's not just small players feeling it.
Not at all. And then you contrast that with Hermès. It's quite stark.
Absolutely. You look at the S&P Global Luxury Index, that's a key benchmark. It's down over 20% in the past year, a big drop.
Wow.
But Hermès, their stock price has barely budged. Down maybe, 4%? It's remarkably stable in comparison.
And the sales figures.
Even better, a 15% surge in 2024, hitting $15.2 billion.
$15.2 billion.
Yeah. And Citigroup analysts, they're forecasting Hermès could reach $20 billion by 2027.
$20 billion, that's huge.
It is. And they're even suggesting Hermès might actually overtake Louis Vuitton in sales.
Overtake Louis Vuitton. Okay, that's a massive prediction.
It certainly grabs your attention.
So that really brings us to the core question, doesn't it? The mission for this deep dive. What is Hermès doing differently?
Mm-hmm.
What are the fundamental strategies that let them not just navigate this slump, but actually thrive? And crucially, what can other luxury groups maybe learn?
Well, the Economist article pulls out 3 key lessons, really. The first one centers on their supply chains, how they control them.
Okay, how so?
It's about their approach. Primarily small, specialized workshops, and they employ these incredibly skilled artisans.
Right, the craftsmanship is legendary.
Exactly. And the numbers back it up. Around 55% of their goods are made either directly in-house or through these very close, exclusive partnerships.
55%, that sounds high compared to others.
It is. The article mentions a Deutsche Bank estimate that puts competitors closer to maybe 35–40% for that kind of in-house or tightly controlled production.
So that's a pretty significant gap, around 15–20% difference.
It really is. And that level of direct oversight, it lets Hermès maintain just exceptional standards every step.
And it's not just the bags, presumably.
No, even for things like ready-to-wear, where they do use external manufacturers, they build these incredibly close long-term relationships.
Ah, like that anecdote in the article about inviting suppliers to their internal Christmas parties.
Exactly. That little detail tells you so much. It's not just transactional. It's about partnership, shared values, a long-term view.
That really paints a picture of a different kind of relationship.
And it seems like other big players are starting to catch on, maybe? The article notes brands like Chanel, LVMH, Prada, they've been buying up their suppliers more recently.
Interesting. So they're seeing the value in that control that Hermès has had for a long time.
Precisely. More control over production, efficiency, yes, but maybe more importantly, over quality and the whole brand story.
So for you listening, it really hammers home how vital understanding and managing that value chain is, especially if your brand is built on, exclusivity and top-tier quality.
Absolutely fundamental.
Okay, so that's lesson 1, supply chain control. What's the second key lesson from the article?
It's about their pricing, specifically their disciplined approach to price increases.
Ah, okay. And you mentioned it connects back to that controlled supply, right?
It does, directly. Because Hermès deliberately keeps its in-house production limited, the supply of those really iconic items like the Birkin or Kelly bags, it's inherently scarce.
Which leads to those famous waiting lists, years long sometimes.
Exactly. They're almost part of the brand mythology now, despite the very high prices already.
But here's the interesting part. According to the article, Hermès isn't just jacking up prices wildly because of the hype.
No, that's the key distinction. Their price adjustments seem much more considered. Bernstein data cited suggests they average around 6–7% annually over the last decade.
6 to 7%. That feels restrained almost in the luxury world.
Compared to some, yes. The article says these increases are generally tied to actual production costs, currency fluctuations, things like that, not just maximizing profit on scarcity alone.
And they contrast that with Chanel.
Yeah, quite a stark comparison. The price of a classic Birkin bag, it's up maybe 29% since 2016. Still a lot, obviously.
Sure, about $12,000 now, based on Sotheby's estimate.
Right. But Chanel's classic quilted bag, over a similar period, its price has more than doubled.
Doubled. Wow. That's a huge difference in strategy.
It really is. It seems a lot of other luxury brands really leaned into that post-pandemic revenge shopping wave.
Right. Everyone suddenly wanted luxury goods.
And they responded with very aggressive price hikes. The article mentions McKinsey data suggesting something like 80% of luxury revenue growth between 2019 and 2023 came just from price increases.
80% from price, only 20% from selling more stuff.
Pretty much. Volume wasn't the main driver, price was.
But now, that strategy might be causing problems.
It seems so. Now that consumer sentiment is cooling off a bit, economic worries are back, maybe those tariff concerns too. Some brands are finding they have to discount.
Or introduce cheaper lines to keep sales up.
Exactly. But Hermès, they seem much more insulated. The article quotes their CEO, Axel Dumas.
Oh yeah, what did he say?
He sounded pretty confident, saying they'd just pass on any potential tariff costs. His thinking is their American customers understand the value, they'll accept it.
That speaks volumes, doesn't it? About their brand loyalty and perceived value.
It really does. It shows the power of a consistent, long-term pricing strategy that's rooted in something more than just market fluctuations.
So for you listening, it's a real lesson in how sustainable pricing power often comes from that deep brand desirability, not just tactical hikes.
Well said.
Okay, so supply chain pricing. What's the third lesson The Economist highlights?
This one's about how Hermès manages to sell less pricey items without sort of damaging the main brand image.
The entry-level products, like lipstick, nail polish, things that are much more affordable than a 10,000-jar bag.
Exactly. It's a way to bring a wider audience into the Hermès world, get them acquainted with the brand.
Like that quote from Carol Maggio at Barclays mentioned in the piece.
Yes, you buy a lipstick today, but in 10 years you might buy a Birkin bag. It's about planting that seed of aspiration, cultivating the future high-end customer.
Makes sense. But the article calls it a tricky balancing act.
And it really is, because if you overdo it, you risk diluting the core brand's exclusivity.
Like the example they give of Gucci. Maybe putting out too many cheaper items like socks and bucket hats.
Potentially, yes. There's always that risk that the brand starts to feel less special, less exclusive, if it becomes too ubiquitous at lower price points.
So how does Hermès walk that tightrope successfully?
Well, a couple of things seem key. One is maintaining a relatively small retail footprint. They have fewer than 300 stores globally.
Compared to Gucci's 530, as the article notes.
Right. Fewer points of sale helps maintain that sense of rarity. And crucially, they limit the production growth of their core leather goods. That 6-7% annual growth we mentioned earlier, that applies here too.
So even as they grow, they intentionally keep that core product scarce.
Exactly. It reinforces the exclusivity, which is why Luca Solca from Bernstein, quoted in the article, says Hermès is basically in a league of its own.
Meaning it's hard for others to copy.
Extremely hard. Their model is built on decades of history, that family control giving them a long-term view, the continuous investment in artisans. It's not something a competitor can just replicate quickly.
That long-term vision and family control definitely seem like recurring themes.
They do.
Now, the article does raise one potential sort of vulnerability, doesn't it? The fact that the market for those super expensive bags, 10,000 plus, is inherently limited.
That's a fair point. There are only so many people in the world who can or want to spend that much on a handbag.
So while Hermès' core wealthy customer might be pretty resilient to economic downturns,
Right. They're less affected generally.
brands that maybe focus more on that aspirational middle-class buyer might actually see faster growth when the economy picks up again.
That's the potential trade-off, yes. When those aspirational consumers feel more confident about spending, brands targeting them might see a bigger upswing than Hermès, whose base is already pretty secure. It's a different kind of risk profile.
It's really fascinating. So it's not just about having expensive things, it's about managing the whole ecosystem, isn't it?
Yay.
For you listening, it shows the real art of brand management.
Absolutely. It's the product mix, the distribution, how you communicate scarcity and desirability,
Yeah.
all carefully balanced.
Understanding who your core customer is, but also how you engage a broader audience without undermining what makes you special in the first place.
Precisely. It's about reinforcing those core values constantly.
Okay, so let's try and bring this all together. Summing up our deep dive based on bags of money in The Economist,
Mm-hmm.
the key takeaways for Hermès' resilience seem to be: 1, that intense control over the supply chain, ensuring quality, exclusivity.
Crucial. 2, that disciplined, value-driven pricing strategy, not just chasing short-term hype.
Right. And 3, the careful, strategic way they offer more accessible products to build aspiration without diluting the core luxury image.
Exactly. And underlying all of that is their unique position, the history, the family control, that unwavering long-term investment in craftsmanship.
Which, as the article suggests, makes it really tough for competitors to truly copy their success, especially in navigating these choppy market waters.
It presents a significant challenge for other luxury groups, for sure.
It really gives you something to think about, doesn't it? Maybe for you listening, consider how these principles controlled supply, value-based pricing, strategic brand extension might apply outside of high fashion.
That's a great point. Are there lessons here for other industries, or even for your own work or business?
Yeah, what can we learn from Hermès' long-term vision that, goes beyond just incredibly expensive, beautiful handbags? Something to ponder.